So let me ask you a question. Are you overlooking what has historically been one of the most consistently profitable sectors in the entire stock market? It's a place filled with names you know, for sure, but successfully investing here, well, it takes a lot more than just trying to pick the next hit TV show or blockbuster movie. It really requires a much deeper understanding of the unique forces that drive real, long-term value in this industry.
Welcome to another video by Mr. Majid Butt on Investment Basics. Today, we are unlocking the media sector. We're going to dive deep into the mechanics of how these companies actually make their money, what separates the truly durable, built-to-last businesses from the ones that are just a flash in the pan, and, most importantly, how you can spot solid, long-term investment opportunities for your own portfolio. And you are definitely going to want to stick around for this one, because at the very end, I'm going to give you an essential investor's checklist. We're talking 6 key hallmarks of a successful media company. This is a practical tool you can start using right away to analyze these businesses and make much more informed decisions.
Okay, so here's our game plan. First, we'll uncover the hidden opportunity that's made this sector so rewarding in the past. Then we're going to follow the money to see exactly how these companies bring in revenue. After that, we'll explore what makes them truly built to last by getting a handle on their powerful economic moats. We'll get to know the key players by breaking down the 3 main subsectors. And finally, we'll wrap it all up with that all-important investment checklist.
All right, let's get right into it with Section 1, the hidden opportunity. So, with all the buzz around tech and healthcare, why should we, as investors, even be paying attention to the media sector? Well, as they say, the numbers don't lie.
Now this tells a really powerful story. Just look at this. Between 1993 and 2002, the broader market, the S&P 500, did pretty well. It gave investors a very respectable 9% return each year. But now, look over at the media sector. It returned just over 16% per year for a decade. That isn't just a little better. We're talking about nearly doubling the market's return year after year. Now, that kind of consistent success doesn't just happen by accident. It tells you something really fundamental, something special was going on inside these businesses. So the big question is, why? What was the engine behind this incredible performance?
Well, you can trace that incredible run back to these 4 key factors. First, the economics of the sector itself are just really appealing, often with low capital needs once a business is up and running. Second, a lot of these companies have these huge, durable, competitive advantages. We're going to call these economic moats, and believe me, we'll get into those in detail. Third, they often created products that were totally different for very specific markets. Think about the only daily newspaper in a city or a publisher of super specialized textbooks. There was just no real substitute. And finally, and this is the big one, when a company dominates one of these unique niches, it almost always leads to what every single disciplined investor loves to see: strong, predictable, and sustainable free cash flow.
Let's move on to Section 2 and see how this all connects. Because to really get a handle on the investment opportunity, you have to follow the money. You have to understand exactly how these media companies generate all that cash. And broadly speaking, it really just boils down to 3 main models, and they all have very, very different implications for us as investors.
Okay, so on one side you have one-time user fees. This is the sexy, glamorous world of blockbuster movies, best-selling books, and #1 songs. The problem for an investor, though, is that it's extremely volatile. You're totally dependent on creating the next big hit. A few hits can feel like a gold mine, but a couple of expensive flops can be a total financial disaster. Not only that, this model relies on A-list stars who demand a huge piece of the pie. A top actor can command millions plus a cut of the box office, which leaves razor-thin profit margins for the company and, its shareholders. Now, on the other side, you have the subscription model. Think cable TV packages or specialty magazines. This is so much more attractive from an investment standpoint. The revenue is predictable, month after month, which makes planning a whole lot easier. But here's the magic part. Subscribers pay you upfront for a service you deliver later. The company gets to use your cash to run its business. It's like getting an interest-free loan from your own customers. It's a fantastic business model that's also way less sensitive to economic bumps in the road.
And the third major model is advertising, the engine that powered traditional TV, radio, and newspapers. The big pro here is something called high operating leverage. Think about it like this. The cost to build a TV tower or hire a news team is pretty much fixed. It's the same whether one person tunes in or 1 million people do. So after you've covered those fixed costs, every single dollar from an extra ad you sell is almost pure profit. That's operating leverage, and it can create incredible profitability. The downside, and it's a big one, ad revenue is super cyclical. When the economy gets shaky, what's the first thing businesses cut?
their ad budgets. This makes these companies very, very sensitive to the overall health of the economy. Okay, so now that we know how they make money, let's get to what I think is the most important concept for any long-term investor, and the real secret sauce behind that outperformance we saw earlier. Section 3, Built to Last. This is all about understanding economic moats in media.
So what in the world is an economic moat? Well, think of a medieval castle. That deep, wide moat around it, that was its main defense against attackers. In business, an economic moat is a sustainable competitive advantage that protects a company's profits and its market share from anyone trying to compete with them. It's that special something that allows a great company to stay great for a long, long time, fending off rivals and earning high returns year after year.
Now, in the media world, you'll see 3 types of moats most often. First, and this is the most powerful, are monopolies. Think about it. Very few cities can actually support more than one major daily newspaper. This gives that one paper immense pricing power with both its advertisers and its readers. Second, you have government-granted licenses. To run a TV or radio station, you need a license from a body like the FCC. And since there are only so many of those frequencies to go around, they create a huge, legally enforced barrier to stop new competitors. And third, economies of scale. Imagine the massive, expensive printing presses for a newspaper. The upfront cost is huge, but the cost to print one extra copy is tiny. This means as they sell more, their profit margins just explode, making it almost impossible for a smaller new company to come in and compete on price.
And look, you don't just have to take my word for it. This right here brilliantly illustrates the point. This isn't some analyst's opinion. This is a direct quote from the 2002 annual report of Gannett, a huge newspaper publisher. They are openly telling their shareholders about their competitive advantage. They're basically saying, hey, we operate local monopolies. When you see a company that can confidently and legally say something like this, you know you found a really powerful economic moat.
Okay, so we understand the business models. We understand the all-important moats. Now let's move on to Section 4 and get to know the players by analyzing the 3 main media subsectors. Because I'm telling you, from an investor's point of view, they are not all created equal.
This table right here is a fantastic cheat sheet for this. First up, you have publishing, newspapers, magazines, books. Historically, this has been the best hunting ground for investors. These companies have those strong moats from local monopolies and economies of scale, which leads to high revenue stability and the potential for really high, and this is the key, sustainable profits. Next is broadcasting cable. Their moats come from those government licenses and in the past from being the only cable game in town. Revenue stability is just moderate because it's mostly ad-driven and we know that's cyclical. The profit potential has been solid, but it's definitely being threatened by new competition from things like satellite and streaming. And finally, you have entertainment, the world of movies and music. Their main asset is their library of copyrights, which is a much weaker moat. And as we've talked about, revenue stability is low because it is a volatile hit-or-miss business. That leads to pretty low and unpredictable profit potential for shareholders since most of the money from a hit goes to the talent, not the company.
And this brings us to a critical, super common investing pitfall. It is so tempting to get all excited and buy a company's stock just because they released a blockbuster movie or a smash hit show. You have to resist that urge. These media conglomerates are massive, complex companies. In all likelihood, the profit from that one hit is just making up for a bunch of expensive flops you never even heard about. So the key takeaway is this. One hit is almost never enough to meaningfully move the needle on long-term profit growth for the entire company. It's more like a rounding error, not a fundamental game changer.
All right, we've covered the landscape, the business models, the moats. Now for the payoff. Let's get to Section 5, your final investment checklist. These are the 6 hallmarks you should be looking for when you're analyzing any media company. This is where we turn theory into action.
First up, look for media companies that consistently generate strong free cash flow. Aim for margins around 10%. Okay, so what does this actually mean? It means we're looking for cash-generating machines. We measure this with free cash flow. That's the real cash a company has left over after paying all its bills and investing in its future. It's the profit that management can actually use to grow the business or return to shareholders. A high margin like 10% or more tells you the company has a product people want and that it's run efficiently. It is a key sign of a healthy, valuable business.
Number 2, seek out companies that have high market share in their primary markets. Monopolies and licenses reduce competition. This goes right back to our talk about economic moats. A company that dominates its market, like the only newspaper in town, has pricing power. It can raise prices without losing all its customers. That dominance protects its profits from being eaten away by competitors, which is the absolute foundation of creating long-term value. Third on our list, seek out companies with a history of well-executed, sensible acquisitions that have been followed by higher margins. The key word, and I mean the key word here, is sensible. We want companies that make smart, strategic purchases that fit neatly into what they already do. We want to avoid the ego-driven empire builders who chase these massive, risky mergers that often just end up destroying shareholder value. Think of the infamous AOL and Time Warner deal, a textbook example of a disastrous acquisition.
Number 4. A strong balance sheet enables companies to make acquisitions without taking on too much risk or diluting shareholder value. Look, to make those smart buys we just talked about, a company needs financial firepower. A business with lots of cash and very little debt is in a position of strength. It can jump on opportunities when they come along without having to take on dangerous levels of debt, or, just as bad, without having to issue a bunch of new stock, which just reduces your ownership stake. Coming in at number 5, look for candid management teams that reinvest capital wisely or return it to shareholders via dividends and buybacks. This one's huge. At the end of the day, when you buy a stock, you're basically hiring that management team to work for you. You want leaders who are honest and transparent. And more importantly, you want to see that they're good stewards of the company's cash, either by putting it back into high-return projects to grow the business, or if those aren't available, by giving that cash back to you, the owner, through dividends or share buybacks.
And finally, the 6th point, which is so important, we're saying it again, don't chase hits. Buying a stock because of the buzz around a popular movie or show almost never pays off in the long term. It's a classic mistake that's driven by emotion, not by solid analysis. A disciplined investor focuses on the underlying business, the strength of its economic moat, and its ability to generate cash over the long haul, not the short-term glamour of a single creative success.
So, there you have it. A complete framework for understanding and analyzing the media sector from an investor's point of view. Now that you have the playbook and that 6-point checklist, I'll just leave you with a final thought to chew on. Which type of media company moat, that local monopoly, that government-issued license, or those massive economies of scale, will you search for first? Thanks for watching.